Whenever we talk about the balance sheet, we need to be aware that we might get asked to talk about it in terms of the qualitative characteristics of accounting, which we've done in earlier topics. So to do this, let's just take an example. We've got this hairdressing salon owned by this lady here, and it's got the following items. It's got a $200,000 property. It's got $40,000 of fixtures and furniture and, chairs and basins and stuff. It's got $10,000 of hairdressing equipment like combs and hair product and stuff, and $50,000 in the bank. However, the business also has a loan with the Bendigo Bank of $100,000. So we know that on its own, this is just a list of items the business has. It's not particularly useful. If this is what you gave people to look at about the business, it's not very professional. It's what when we started the course, we said it's really just financial data. We don't want data, we want information. Information is something I can make a decision on, so it's not great. And on its own, you could kind of argue that's a little bit useless. Look, this is a very small business, so there's only a few items. But imagine if, like Ford or Tesla or Facebook or Kmart or any big business gave you just a list of everything they owned and all their debts, you wouldn't be able to make sense of it. So that's not good enough. So what we learned that after that, well, there's a thing called the accounting equation. That's a little bit more useful. So we could say here, we added up this, 200 plus 400 plus 10 plus 50, that's $300,000 of assets, equals liabilities. We've got the one loan to the Bendigo Bank, and now we've got the owner's equity of 200,000. Well, that's starting to look a bit better. It now shows us what we call the financial position, the sort of relationship of your assets to your liabilities and owner's equity, but it's still not great. I know we can see the relationship between these numbers, but we can't really see the individual items. If this was all we gave people about the business, well, it's not very practical. So we'd like a bit more. So we're getting better, but we want a bit more info. So what we do is we set it out in a balance sheet, and we've got on this side the asset side. Well, all we do is list all the assets individually. So we've got the premises, the furniture and the fittings, the salon equipment and the cash. On this side, we list the liabilities, the Bendigo Bank, and on this side, we list the owner's equity, which is the capital of the owner, which is 200,000. We total it up. Total assets of 300 and total equities of 100 plus 200. And now we've got something we can really use. And that is because it's very much better. Now, why is it better? Well, we can express that in terms of the qualitative characteristics and say, first of all, this is more relevant. What does that mean? Well, it means it's got financial information that we can now use for our decision making. Okay, we can not only see the overall balance of all the assets, all the liabilities, and all the owner's equity, but we can see each individual item as well. So we've got a nice balance there. And now that we've got that, we can make some decisions based on that. Which also helps back up verifiability. And why it does that is because we know that for each of these items in here, so let's take the premises. When the business bought the premises, it's not just a made up number. It would be verified with a source document. Each of these items will have a source document to back it up as evidence. So we know these numbers are not just estimates and guesses. You could also argue it helps fulfill what we call faithful representation. And what we're saying is this actually represents the real world financial position of the business. It's not made up. And it's free from errors and without bias. Why? Because it's verifiable. We have all these source documents to back it up. And we can also see, we said part of this is like it's got to be free from errors. Well, the balance sheet literally proves that. It proves that the assets equals 300,000, which must be equal to the liabilities of 100, plus the owner's equity of 200. It balances. We can see it doesn't have an error. So that's good. And lastly, we could say it also fulfills what we call understandability, which means that someone reading this, the user of the report, this is a more comprehensible and understandable report than just having a list of items or just the accounting equation. So they can clearly see now and understand what the assets of the business are, what the liabilities are, and therefore what the owner's equity of the business is too.